Welcome back to ACCA paper P4 on Advanced Financial Management. Today we want to talk about a rather specialized area called corporate reconstruction and reorganization. Now, this is the sort of thing which is happening occasionally when a company needs to undergo some kind of restructuring measures, either forced restructuring because it's in difficulty or in danger of failing, or it could be a voluntary type of restructuring because the company is doing reasonably well but wants to do even better by streamlining the way in which it is financed. In other words, we're looking at the liability side of the balance sheet and we're saying to ourselves, how can we achieve a more effective structuring of the long-term financing of the business? Now, by now it should become clear to the candidate that financial management is primarily concerned with the liability side of the balance sheet. Such issues as how should the capital be structured, what are the sources of the different components of capital, what is the relationship between debt and equity, how should the capital structure reflect the desired leveraging, financial leveraging in the company, what currencies, what maturities, whether to have floating rate or fixed rate liabilities, preference shares, all of these things, also the dividend policy, all of these are areas of legitimate concern for the CFO, and therefore when we speak of financial reconstruction, we speak about the rearrangement of a company's finances in the most general sense of the term. Now, of course, the most dramatic types of reconstructions is when a company is, in fact, in danger of collapse or failing. So if there is a threat of failure, corporate failure, then if time permits, a company may look to rearrange its financial situation in such a manner as to continue to operate. In other words, it may seek bankruptcy protection. And bankruptcy means not necessarily to liquidate the business, but to reorganize the business with a view to recapitalizing and carrying on the business in a way which will hopefully be sustainable and lead ultimately to business success. A number of businesses in the US primarily have gone into bankruptcy and have re-emerged from bankruptcy in a stronger position because they've been able to renegotiate and to reorganize the liabilities that they had. If you look at the American airline industry, for example, that's the various companies in the airline industry have undergone periodic bankruptcy reorganizations, what we call Chapter 11. Now, we don't have to be corporate lawyers here. We just simply need to think about what from a financial point of view, what the steps would be for financially reconstructing a company. Now, when we evaluate reconstruction schemes, it's normal to begin by performing a liquidation scenario. In other words, starting with a worst case scenario to see what would result from a liquidation of the company and who would be paid their money among the creditors. One has here ranking of claimants or creditors according to their preference, and it goes right down through to the last group, which would be the common shareholders. Common shareholders are in the most vulnerable position because they will lose the most potentially if the company fails, but of course on the other side, in return for that risk which they take, they also have most to gain when a company does spectacularly well, because the profits ultimately go to the common shareholders. So again, this is merely reinforcing our notion of the relationship between risk and reward. Now, when we are evaluating a reconstruction scheme, we have our liquidation scenario which serves as a base case. In other words, if liquidation takes place, this is what the various groups will receive from the liquidation proceeds. In this way, we can look at a reconstruction scheme to see what the proposal is and to compare the situation of each of the creditor classes against the base case and see whether the reconstruction scheme would make them better off or at least no worse off than if liquidation were to take place. In other words, this evaluation is a bit of guesswork. It's saying basically what are the chances that the various classes of creditors will agree to a reconstruction of the company. There's no absolute answers here. It's a question of anticipating and trying to find objective arguments as to why a particular class of creditors should seriously entertain a rescheduling or reconstruction scheme, or are they likely to say, let's just go for liquidation. Even if we do not get all of our money back, at least we will save time and effort, and it will be quicker through a liquidation than to go through all of the legal work and documentation necessary to bless a reconstruction scheme. Others, and banks fall into this category, may simply say it's not worth the hassle to get the internal approvals for going along with a reconstruction scheme, and therefore liquidation is kind of the not a pleasant way out, but it's perhaps the easiest way out, even if there is money that's written off in the process. So what we're doing here basically is sort of the political arithmetic connected to reconstruction schemes, and systematically need to go through each of the creditors to see what their likely position is. If one were to advocate a reconstruction scheme, it's always important before going into negotiations with counterparties to understand what is important to the counterparty, the negotiating partner, let's say, and what is not important. What are they likely to be willing to give up? And this way it helps one to form the right arguments to be able to appeal to the creditors. One other aspect that we have to keep in mind when we look at reconstruction schemes is that there may very well be the introduction of a new investor. Let's take, for example, a venture capitalist who sees the financially distressed company as an opportunity to come into the picture at preferential terms, possibly to take a majority shareholding of the company, and to be able to acquire a ownership stake at a very low price, and thereby be able to influence the direction of the company in such a way as to make it a profitable company again. Now, the venture capitalist or a new investor will not be included in the list of existing creditors of the company. It's part of finding a way to bring in fresh capital. Now, of course, it's possible that any of the existing claimants on the company's assets may also be willing to introduce fresh money for the company to be able to reconstruct itself. That depends on the particular circumstances. In the exam, if one has such a question, it is likely to be, here is the proposed reconstruction scheme. Please evaluate this against the prospects for the company and see whether or not it is likely to be accepted by the various creditors. Again, one doesn't have to have a detailed knowledge of corporate law, bankruptcy law, in order to be able to do these questions. What is looked for here is the ability to be able to examine and to quantify and to understand what the impact will be of the reorganization or the reconstruction proposal on the finances of the company, and whether or not the various creditor groups are, how they stand if they vote for the reconstruction scheme as opposed to voting for liquidation. It's a very interesting, very important area, and certainly important in light of the economic downturn, which has seen many business failures, and therefore the need for this sort of work has actually increased over the past years. Thank you.